Thank you very, very much indeed. And thank you for joining us for this last panel of the day here at the Island of Hope before we break for a well-deserved drink, whether you've been here all day or come down from the Green and Blue Zone. Particularly thanks to those who have made it from the Green and Blue Zone to be here this afternoon. Sometimes, timing is everything, and it's been a real pleasure and privilege to be part of a report that has sought to, and I have it in my hand, a report led by Dr. Anna Gonzalez-Belize at Cambridge, which we'll hear about in a minute, that seeks to describe how we could implement loss and damage related funds very effectively and very fairly and very efficiently. And I remember when this was conceived in the last year, the idea of writing something about loss and damage was considered to be an extremely risky thing to do from a reputational point of view, probably academically, and certainly for a company like Howden to be involved in it. And it is exciting that just as this report was finished and published, I think last week by Cambridge, Anna, that the loss and damage diplomatic breakthrough occurred, and indeed funds were obviously assigned on the very first day here in Dubai. And here is a contribution to the next stage, which is not if, but how we apply that. In a little while, we're going to have a summary from Anna of the research, and then we're going to hear some very important perspectives from the public and private sector. I'm going to slightly change the order, because obviously we've all been managing the geography of COP this year, and Isaac Anthony, who's the CEO of CRIF SBC, the Caribbean Catastrophe Reinsurance Pool, the multi-sovereign program. Isaac, you can only be with us for, I think, about another 10 minutes or so, can't you? And so we're going to give Isaac the first word. Anna, you'll get the last word, but Isaac's going to have the first word because he's going to have to leave. Not quietly. We'll have trumpets when you leave. Okay. But one of the great things about this research is it is groundbreaking, but at the same time it respects the desire for no more initiatives, no new initiatives. So do not think that anything about this is new. We're building on existing foundations, but just applying it in a bigger and braver way. And one of the key foundations that this is built upon is the experience in the last 10 years of something called the regional catastrophe pools. These are groups of countries that have come together to manage their natural disaster risk. The very first was in the Caribbean, and the first CEO of it was Isaac Anthony, and clearly it's been very successful because Isaac, you're still the CEO of the CRIF, which both means it's made its clients, which are governments, very, very happy. And really what's been described in the report is ultimately building upon these foundations. So Isaac, if I could ask you the first question, first of all, what's your feeling about the opportunity to use loss and damage and other funds to provide the structural protection that countries need? And what are some of the lessons perhaps you've learned in the CRIF which you think could be applied, and could we use the CRIF as an implementing entity for this new loss and damage response?
Yeah, thank you very much, Rowan, for that question. And again, thanks for inviting me to be part of this, I think, very important and indeed very timely discussion. As you indicated, the CRIF has been in existence, in actual fact, for 16 years. And, when it was established, it was really done for the governments of the Caribbean. The reality is that it has expanded into Central America. We've been able to make quick payouts following an event. So we use what they call parametric insurance, which enables you to make that payout within 14 days of that event happening. And we've been able to do so consistently. And we've made about $267 million in payouts. We've also been able to scale up. So in addition to expanding in Central America, we've added additional products. And we see now the opportunity to grow this pool. Now, the reality, though, is while the CRIF has been able to achieve its value proposition of making quick payouts to the government, because they don't want to wait until 6 months to be able to get a payout, they want it now to be able to respond in a very effective and meaningful way to the population. The reality, though, is that, you know, those payouts are still relatively small compared to the overwhelming cost of having to rebuild. And I always use Dominica, and we have Francine here with us, as an example. Following Hurricane Maria in 2017, they got a payout of $20 million. But you see, that was the coverage they purchased at the time. But they got it within 2 weeks. And that certainly assisted the country, the government, in terms of helping to clear the roads, the rivers, provide food, water, medicine, those critical things that are needed as part of the whole recovery process. But the losses were for that single hurricane event, and she will tell you more about it, was over $1 billion. So the question is, where is that additional funding coming from? And this is what this is all about. You know, being able to scale up, you know, insurance, well, first of all, CRIF and other facilities to be able to respond and take advantage of the resources that potentially will come from the loss and damage fund. So that's the first point that I want to make. The second point that I want to highlight is in terms of the setting up of the loss and damage fund, the operationalization. You know, we do not want to get mad in a lot of bureaucracy and red tape to be able to access resources. And this is one of the big concerns that are coming from governments. You know, how are we going to, how quick, because speed is going to be important. Because as we can see, climate change in terms of the impact is unraveling very quickly. Countries are having several big events every year. The reality is that you need to be able to access resources, the financing that is needed to be able to respond. And therefore, you need to have a facility, a loss and damage fund, that can also respond very quickly. And so we have to put the emphasis on that. The one point I also want to make is that we have CRIF, where we can draw from the lessons of CRIF in terms of how it was actually set up. CRIF is a very simple institutional framework. Yes, it is the beneficial owners are, in fact, the government, but it was really set up as a captive insurance company in the Cayman Islands through what I call a segregated portfolio structure and through a trust arrangement. We do not have to go through governments every year to be able to make decisions, to be able to facilitate the support that CRIF can provide. So without going into a lot of detail, I would strongly encourage that as we consider the operationalization of the loss and damage fund, which is going to be key to scaling up, that we try to leave the arrangement as efficient as possible that could facilitate quick disbursement of resources to the governments to enable them to respond more meaningfully to the advent of the impacts of climate change.
Isaac, thank you very, very much indeed. And if you need to, when you need to step away, please feel free to do so. Now, to highlight that this is going to be a slightly interactive panel, I know that Anna's got some slides to show, and I can see there are 4 or 5 seats. So what I'm going to suggest is, if you don't mind, the panelists come and sit down briefly, because I don't think we'll be able to see the slides, Anna. I don't want to leave you completely on your own, but Anna, I've got the clicker here.
Yeah, it's okay. You send me to a
Yeah, exactly. So Anna, the research you recently released at the Cambridge Institute for Sustainability Leadership found that the climate-vulnerable nations risk losing over 100% of their GDP from climate-related disasters. Can you explain why this quantification of climate risk as percentage of GDP was such an important breakthrough?
Yes. Okay. Hello, everyone, and thank you so much for being here. Many of you have contributed to this analysis, to this study. It has taken probably a team of around 100 people in different ways involved to arrive to here, to today. So apologies, I cannot mention you by name because we are pressed for time, but we are very, very grateful. So we have done two things in this study. One, we have quantified in the momentum of loss and damage and in the scale of funds that will be available. We have been addressing how to make those funds efficient for donors and also fair and equitable for recipient countries. So one key element that was missing in the loss and damage dialogue was figures, quantification of what is the scale of the risk that we are talking about, and is it possible to protect that amount of risk? So we have done exactly those two quantifications in a group of a sample of 12 countries from the Caribbean, Pacific, and Indian Oceans. And in the first step, we analyze the risk that these countries face in terms of GDP, 6 climate hazards, and so, as I mentioned, crucially related to GDP. And now, in the present time, and also all the way to 2050. The figures we obtain is what we are going to show in this first slide. Of course, we won't stop here for long, but it's just to share with you the sophistication and the depth of the calculation that our teams have done, the technical teams. So, these countries, they are the V20 seeds, small island developing states with populations under 1 million people. Most of them risk losing between 50% to over 100% of their GDP right now. That can happen anytime. And for some of the countries, that level of risk can go all the way up to almost 300%, and it's really humbling and a real honor to be sharing this panel with Ambassador Francine from Dominica, which is a country who has experienced this. I think Francine will tell us in a moment, but I think it was 225% of GDP loss. All of this is very real, and it's very real right now. And we wanted to put these kind of figures to the loss and damage conversations, the negotiations, the conversations, the discussions that are happening right now. They did not have this type of quantification to inform what we are talking about with metrics that both risk capital markets and climate negotiators can use in an efficient way. Once we had these figures, our next question was, can we actually insure these countries? Can these economies be insured? Can they be protected? And if so, how much that would cost? So this is the final slide that we will be showing now, but we have a lot of this data shared in the report. The answer to that question is yes, these countries can be insured. How remarkable that is when we are talking about 300% of GDP loss, and how remarkable that is to bust many of the myths that we are having, that there are around, that actually these economies cannot be insured. And what we have tested, the second element that we have tested is if they risk losing up to 300% of their GDP, is to what is the level of GDP that we can insure the losses from, that is efficient for the risk capital markets and that is efficient for donors. And we didn't know what the answer was going to be to that. We thought, first, we didn't know if that was going to be possible. Second, we didn't know if we were talking about a threshold very high, like 30%, 40%. You cannot insure below that. We were able, our technical team, actually this was the Howden technical team, and an army of mathematicians, actuaries have been involved in this, were able to bring it down to 10% what a game changer that is. These countries can be protected from any losses above 10%. And now this is where the magic comes in of the figures. The price to cover these particular countries is around, in pure premium terms, 300 million. That per year, that unlocks $25 billion of protection from the risk capital markets, guaranteed prearranged financial protection. So 300 million in estimate terms. So this is a pathfinder. Let's not get caught up in the precise technicalities of how accurate this is. This is a study, a breakthrough study to inform loss and damage conversations that are happening right now. So pure premium, 300 million to unlock 25 billion of guaranteed protection for these countries. Can we scale this up? So we then calculated all the countries that share the same characteristics, around 30 countries in total in the world, under 1 million people. So 1 billion annual pure premium would unlock 75 billion from the risk capital markets of prearranged guaranteed protection for these economies, unlocking investment, giving them time to adapt and to make informed adaptations, of course, with all the analytics and the modeling that has to be put in place as well to develop this type of financial products. So this is one type of quantification we have done, but of course, this is applicable to 30 countries. Then we thought, what can we quantify that can be an option for all countries in the loss and damage domain? So, and that could be applied immediately. So we thought, if every country in the loss and damage, possibly loss and damage recipient, we calculated, or we estimated around 100 countries. That could include all the V20, the vulnerable 20 countries, low-income developing countries, and all the small island developing states that qualify for donor help. So if each of these countries immediately, as part of the loss and damage momentum, they are given 10 million of annual premium, how much protection that would unlock for their highest priority needs. We are not talking here about covering 10% of GDP. Maybe it's even better to now not to have this slide on, because so this was one of the options. The other option is we are thinking now 10 million for each country. How much would that unlock? Around 250 million for high priority needs. This is for risks that happen frequently. And that, even if it's not enough, and it's, of course it's not enough for most economies, but to many of them it would make a great difference already. To others it would be only a beginning. But what it could do is to create immediately a global risk-sharing loss and damage system where each country is already part of a global system where then more premium funds can be increased as the negotiations progress and as more funding is allocated to loss and damage. So I think I'm going to leave it here for now. These are the two proposals that we bring to COP and that will continue working in the coming year.
Just two questions. The first is, this is now, but we know the climate is changing. I think the research also looked into 2050 and the mid-century, because obviously there was a desire to understand, is this sustainable over the next 2 or 3 decades? I think you might just want to provide a bit of input into that too.
Yes, so we looked at the risk now and the risk to 2050, and that's set to increasing about 0.5% per year due to climate change. But still, the calculations that we did, still within modest increases to the premium, these economies still remain insurable.
Yeah. And it's just worth, before we go back onto the screen, just to look at some of these figures. The bar charts are different sizes for two reasons. One, the economies are very different sizes. You're dealing with an incredible diversity of countries. They're all called SIDS and they're all 1 million population or less, but they're hugely diverse, both in the size of their economy. The Barbados, for example, is a middle-income country. Its GDP per head is about $18,000 a year. So it's quite a large economy. Actually, probably a mid-range in terms of levels of risk. It's towards the southern part of the Caribbean. But so you'll see, so relatively lower risk, but larger economy to protect against 10% of GDP. So here, $92 million of pure premium a year would unlock nearly $7 billion of contractual protection.
Yes,
Incredible structural recovery. But at the other end of the spectrum, when we're dealing with small islands in the Pacific, the sort of numbers we're talking about for countries which actually in the Pacific risk is driven often by drought, we're looking at relatively small numbers, 4, 5, even $3 million a year in the context of Tuvalu, a population of just 11,000 people, would unlock $86 million of protection to actually respond to relatively frequent events. Actually, Tuvalu's risks are driven by events happen at sort of 1 in 20 to 1 in 50 type return periods, whereas actually in the southern Caribbean, for example, I think we've got Grenada, for example, actually in the southern Caribbean suffers less frequent events, but is subject to extreme hurricanes, and that's why you see a relatively low premium amount, but for a high payout. So, but the ultimate end game of all these countries is the same. They can't lose more than 10% of their GDP financially. So the climate will change, but their financial state need not change over the next 2 to 3 decades. That's structurally important. Anna.
Yes, no, and the beauty of this graph is just to show the power of the risk capital markets. That tiny orange sliver of premium unlocks all the blue space. It's enormous. And this is just such a central message to bring to the loss and damage negotiations and to the loss and damage momentum. That this is a key instrument for the restructuring of the global financial system that's being spoken about now, and just such a visual representation of it.
Thank you. If I could ask the panelists to come back now, obviously for those. Yeah. Okay, we are, as Anna mentioned, we are incredibly privileged to have Ambassador Francis Bacon here. Thank you very much for coming down from the Blue Zone, from Dominica, as we heard. Tragically suffered that severe loss through Hurricane Maria just a few years ago. Ambassador Bacon, the figures of over 100% of GDP loss are shocking, and you've experienced that. Can you tell us a bit about the impact it had on Dominica economy, and what kind of difference the existing pre-arranged financing you had made, but also what this more structural macroeconomic protection could make to Dominica if we could mobilize the sort of support to provide it?
Okay, thank you very much, and it's Baron.
Baron, this is...
Yes, so we would have had, as was indicated, the impact of Hurricane Maria would have destroyed the equivalent of 226% of our GDP. And this would have come 2 years after we had had a tropical storm that destroyed the equivalent of 90% of our GDP. So we really had 2 massive shocks in a very short space of time. With Hurricane Maria, we would have had significant impact across the island. And we would have had, for example, 43 of our 44 water systems destroyed. We had up to 4 months after Hurricane Maria, still 90% of homes that had no access to electricity. And of course, in the immediate aftermath, we would have had a complete cessation of economic activity for a period of weeks, whilst significant sums would have been expended in the immediate response and recovery effort. And so the government would have been spending significant sums with no income coming in. And so for us, the impact of Hurricane Maria was extensive. It was devastating. And you would have heard from Isaac earlier that we had an insurance policy with CRIF. However, that policy unlocked $20 million. But we suffered loss and damage of about $1.3 billion. So this was just a tiny drop in the bucket that was available to us to respond. What we have done since then is to look at ways in which we can be able to create a better buffer or better enable us to respond to disasters like that, because we have set out on a journey to build the first climate resilient country. And that requires us to have systems in place that will allow us to minimize damage and recover much more quickly. And so we've looked at having CAT DDO bonds with the World Bank. We have created a vulnerability risk reduction fund where the government puts in an amount of $500,000 a month into a special fund so that we would have access to funding immediately after an event, so that we can limit the period of downtime and be able to recover much more quickly. And also looking at increasing our CRIF coverage as well. I think fortunately for us after Hurricane Maria is that government had some funding available earmarked for a number of different projects that then had to be diverted to the recovery process. What that means is that money that should have gone towards economic development had to be spent on the recovery process. And so this is the type of events that has caused countries in the Caribbean to be highly indebted, because you're continuously spending on having to rebuild after extreme events, and you have to borrow to rebuild infrastructure, and you're not moving forward. So it's important for us to be able to have access to financing, and for us to have that access to financing within a very quick period of time, because the longer that it takes for you to recover, it means that you have greater losses. We would have had 90% of homes damaged as a result of the storm. There was 62, maybe about 62% was heavily damaged, just about 30% was completely damaged and destroyed. So the impact of these storms on our countries and small states is very significant. And typically the insurance coverage, and certainly for Hurricane Maria, insurance coverage was at about 20%. And I'm talking about for private households. And so government became the insurer of last resort, really, to these homes. And so the pressure on the government was even more significant. So when we talk about the possibility of unlocking finance from the risk capital markets of a much larger amount than traditionally we would have been able to secure, then it's something that is likely to be beneficial to small states like ours. Certainly $20 million, it's a drop in the bucket of what is needed when 226% of your GDP is affected. And so we have to look at effective ways. The insurance is one of the ways in which we can address these issues of loss and damage. Obviously, there are other areas that we have to have regard to as well, but the insurance is a critical part as well. So I'm pleased to see the work that is being done along those lines. And of course, we need to study it more to see how best to take advantage of that work.
Thank you so much, Ambassador Barron. Thank you. Jorge, I wonder if I could turn to you as the as it shows, you're Director of Global Policy at the Atlantic Council, the Arshrock Centre for Resilience, but also I know that you've been working with the UN Climate Champions, leading the work on resilience and adaptation. You've also played quite a role in helping to shepherd this research within the sort of within that process. But let's get your sense of how this is landing within the UN discussions on loss and damage, but more broadly the approach you think it offers.
Thank you, Rowan, and thanks for the invitation, David, Anna, Rowan. One another aspect of my background is that I used to be a climate finance negotiator for the government of Peru. I negotiated both a Lima decision as part of the presidency and also the Paris Agreement on the chapter of climate finance. And that gave me a bit of perspective in terms of how countries, both developed and developing countries, see climate finance as a bargaining chip between adaptation and mitigation. So just a bit of background on that, on what I'm going to say now. Loss and damage has moved from being a fringe issue and a controversial, politically controversial, very charged aspect to a mainstream issue that could be certainly discussed openly and broadly in the negotiations. It shows a spirit of global climate collaboration and cooperation, that it needs to sit at the core of the negotiations moving forward, and at the core of any mechanism that we could develop, such as the Loss and Damage Fund. That's the good news. I think the challenges moving forward in the process, again, seeing climate finance as a bargaining chip, is that climate finance in the process is seen as an obligation from developed countries to developing countries. And that poses a challenge in terms of how we're going to be seeing the application, intervention of the private sector, such as insurance sector, into this process. That's the first challenge. The second challenge that the process puts on the table is that there is no scientific-driven discussion on the loss and damage negotiations. It's both compensation components from the past and a moving forward calculation of potential future losses and damages. So from a temporary dimension, we have both a mix and a mix of thinking around what happened before and what's going to be happening in the future. If I may make a controversial comment here, the more we keep that separation, at least in the climate finance perspective, between developed and developing country, the more losses and damages we're going to have in the future. Because leaving China, India, Brazil, Indonesia untouched, and waiting for them to be paid losses and damages from the past, allows them to become the next causes or causing factor for future losses and damages. So we cannot disassociate the negotiations between mitigation and expectations for developing countries that are major emitters from the loss and damage conversations. So, and the second challenge, so those are the two challenges. I would say that moving forward, the opportunities on those to build on those challenges are first on the participation of the private sector and insurance sector in particular. There is a mentioning and a consideration by the Transitional Committee of the Loss and Damage Fund to include mechanisms of disaster risk finance, including insurance. So there is an opening there. It's just a matter of how we move from that being a fringe issue into becoming a mainstream issue. So that's a political challenge, and that could go via the negotiations per se, which I advise against, or could go via parallel mechanisms that will show the value of this kind of approaches and then make that mainstream into a political process down the road. And then the second challenge that I was putting in terms of science-driven information, I think that it required, and I would suggest it would require a massive engagement with developing countries and also developed countries for them to understand that any conversation around loss and damage has the potential. The tools are here. the mechanisms are here. The insurance sector is willing to put those analytics capacity and power in the hands of the public, in the public realm, and make sure that that is openly understood and taken upon. And that would, I would say, would require either, again, utilizing existing mechanisms that such as the mechanisms that the multilateral banks have, or the Green Climate Fund or others to advance that knowledge. But certainly, in what sits here in the challenge moving forward cannot diminish the value of this analysis on the one hand, and the momentum that we have. There are no coincidences, and timing is. There are no coincidences on policy and politics. Timing is everything in policy and politics. And I think, Anna, you had a brilliant foresight to land a report right in the moment in which loss and damage moved out from a fringe issue into mainstream. So congratulations on that, and so looking forward to keep working with you.
Jorge, thank you so much. David, I wonder if I could turn to you. Anna's said that insurance could be one of the most efficient ways to use those hard-won loss and damage funds, and the $1 billion a year to provide umbrella protection for the 30 smallest countries. Well, if the loss and damage fund gets to its ambition of 100 billion a year, that's just 1% of the loss and damage funds. Could you explain how the efficiency of the insurance market works in this case, and why would the insurance sector be interested? We're often discussing that insurance isn't interested in climate risk, and the global south isn't attractive, but that may not be the case.
Okay, if I sort of take that from the efficiency point of view, first of all, of the clients, the recipients of the insurance. So I think Ambassador Barron made a very good point about investment, and I think that whatever you're going to do with the loss and damage fund or anything else, it has to be about not just actually after the event. It has to be this thing of encouraging investment, or whether it's the country knowing it can invest rather than diverting funds elsewhere, or whether it's investors feeling they can invest. And to me, that's absolutely critical with insurance. It gives you the confidence for investment, whether you're the country or whether you're an investor. And I think that's one of the big efficiency points. It's two sides of a very powerful coin. One is providing the funds that's needed when the disaster happens, but as importantly as that, it's providing the protection, the security to allow investment for development before that. And that's because no one knows when these things are going to happen. So to me, that's the efficiency point from the client point of view. The second efficiency point from the client point of view is the point that Isaac made. They need the money now, yeah? Your example is, at the moment, look at the terrible floods in Pakistan. 9 billion was raised by the United Nations 3 months after the floods. But my understanding is actually very little of that money has actually reached Pakistan. I think in Puerto Rico, there was billions promised. Very little of that money actually reached Puerto Rico. So this is about certainty for clients. It's about, a guarantee of pre-agreed funds. And that, to me, is the efficiency point of view from clients. Let's just look at the efficiency point of view from the capital markets. Most of the capital markets investment in disaster is in the global north, about 270 billion of premiums. I'm sure, Ricardo, you wish there was more coverage because there isn't enough capacity actually for providing any more capacity in the global north in certain areas, and that's why a lot of it falls on government. But so think about that. There's almost a saturation of insurance capacity in parts of the global north. Most of these countries we're looking at, this 100, are countries where actually there's significant underinsurance, if any insurance at all. So that diversification risk is massive. And what does that mean? It means it's cost effective. Most of these insurance companies might not have to put any more capital on their balance sheet to be able to provide this risk. In fact, they might need to help their balance sheet because of diversification. They might even have to lower their capital requirements. That's why it's so efficient for the insurance market, and that's why the pricing of it will be incredibly efficient for the buyers, the donors, but also critically for the clients who are having it. So to me, I would say this, I guess, it's very obvious that it has efficiency both for the buyer, and for the client, but it is also efficient for our market. And I would just one last point, make the point that I think the insurance market often be seen as a for-profit market, but its capital efficiency can often be very effective. You take renewables, you look at renewables today, there's probably about 3 billion of premium insuring renewables. Insurers have not made money from insuring renewables ever. It's one of the worst loss ratios of the market. We've taken the risks off the banks, we've taken the risks off the private equity, we've taken the risks off the governments, and it's actually a loss-making thing. So don't believe the insurers are so smart that they're actually going to be on the right side of the equation always. That's not often always the case.
David, thank you so much. Now, some of you may be wondering, this is an event about the Global South and loss and damage. Why do we have the Insurance Commissioner of California, one of the richest, probably the sixth richest, well, you're probably ahead of the UK now, fifth, yes. Yes, we used to be fifth, now we've fallen behind California and even France. So there we go. Why have we invited Commissioner Lara here? Well, for two reasons. The first is that, as many of you will know, California as a state runs an entity called the Californian Earthquake Commission, which is a public entity which manages the earthquake risk of millions of Californian homeowners. And to manage that risk, it actually purchases reinsurance from the international capital markets, both reinsurance and catastrophe bonds, purchases nearly, I think, $9 billion of protection a year. We wanted to invite Commissioner Lara to talk a little bit about that, amongst other things, to highlight that what's being suggested for small island developing states is absolutely nothing new. This sort of protection isn't just what the poorest and most vulnerable countries should have. It's what some of the richest countries already purchase to protect their own balance sheets. It's absolutely sort of regular, and I see Sid Miller here, who used to run the Earthquake Commission in New Zealand. Around the world, I don't think there's a single developed OECD insurance market that doesn't have actually a public-private combination. But the second reason, and I didn't actually tell you this, Ricardo, the second reason we invited Ricardo Lara is, and you may not know this, but in California, the insurance commissioner is an elected position in the state. So Ricardo is both an insurance commissioner and a politician. So who better to help us navigate the politics at both the national and global level of insurance? Because ultimately insurance, as Anna often says, is an institution of society. It's a political mechanism of how we understand and share risk. So Ricardo, would love to have your perspectives from California on what you think it could help support the Global South, but also what we can learn from the technical innovations in the Global South in California.
Absolutely. Thank you, Rowan. And you're absolutely right. As all the developed nations have some sort of form of being able to not only quantify but and diversify the risk for some of the catastrophes that insurance companies, traditional insurance companies, no longer are covering, right? That is what happened in California after the Northridge earthquake. Insurers stopped insuring earthquake in California, so we were left without any choice but to create a government entity. Now that's given us some really opportunities now over a couple of years to really understand, not only as government shifts into creating a pseudo insurance company, understanding the limitations that brings, but also the ability to start working on the mitigation side, which is the critical piece, right? If we're going to get insurers to come into states like California or in the Global South, mitigation has to be part and just as important, because lowering the risk is what we all need to do in order to bring in investment and insurers. Now, I'll tell you that in California, around the California Earthquake Authority, it's been very successful of being able to diversify its risk, raise the capital it needs to cover the cost. And as David was saying, we need insurance companies to make money because we need them to be able to pay out the claims, right? And so what we're seeing in terms of now of years of having the California Earthquake Authority is still the fact that we lack that mitigation strategy, so that we're now finally working on we've had a brace and bolt program that gives money to consumers to be able to protect their homes. But we're not doing it at any big scale that's going to continue to maybe one day bring insurers back to writing insurance, earthquake insurance in California. And my fear is that if we continue to go this route without addressing the mitigation piece, we're going to be stuck with having to figure out, like we have in the national level in the U.S., the National Flood Insurance Program. What are we going to do with wildfires? What are we going to do with sea level rise, with extreme heat, for example? And these are all questions that we're having in California, as you say, one of the wealthier states, and California's insurance market is the largest in the country, fourth in the world, but we're still having these similar problems. And so as we develop this fund, the loss and damage fund, one, it has to prioritize mitigation. It has to prioritize it because that's how we get insurers to be part of this. If we lower the risk, and so now we're looking at how do we use insurance not only after the fact, but how do we utilize insurance to promote good behavior? So I'll give you an example of what we're doing in terms of for our local governments. We've created something called climate resiliency districts. So the electeds come in, create this climate resiliency district, which then allows the individual homeowners to raise their own taxes to be able to commit those to projects just on climate mitigation. So then the community is working together to raise its own fund. They essentially tax themselves to bring down the mitigation, to bring down the risk, whether it's earthquake, wildfire, extreme heat. And we're starting to see now private business and insurance sectors coming in to start to want to engage in these communities. And some of these communities are some of the most riskiest ones in California. So one, yes, these the loss and fund can work. It has to work, but it also has to include mitigation to help those communities that need it to bring down the risk, to keep these financial instruments not only strong, but to continue to keep investments coming into these communities.
Commissioner Lara, thank you so much. And it's absolutely a continuum: mitigation, adaptation, loss and damage, insurance. And ultimately what's been exciting is how a common thread of risk modeling and translating physics into finance and getting it into the guts of financial decision making, at the macro level or down to the household level. So, as I said earlier, there's nothing new in this. So, we've got the Global Risk Modeling Alliance and the Global Resilience Index, Planet Resilience Hub, providing those sorts of capabilities for countries north and south. IDF's in there, obviously EcoSway, in implementing institution for this sort of activity. SMI is propagating this message into wide markets, regional risk pools. The key thing in this area is, I think, all of the institutions exist to be able to implement this sort of thing, and actually well choreographed. We have the Global Shield, but we just need to find a way of amplifying things at scale. And indeed, what it really means is that the person buying the insurance policy in California is actually sharing their risk with someone in Fiji, and vice versa. The global reinsurance system is the most incredible global community product. Most of us give far more through our insurance policy premiums than we do in charity to protect climate resilience, because we don't realize it, but we're actually sharing that risk. And we need to. The problem is not enough people are members of that community. We need the right source.
And even communicating that risk
Yeah.
to the policyholders is critical, and to the community. Because I'll even tell you, what do you think the take-up rate is for earthquake insurance in California?
It's 18%, 20%.
2%.
Oh.
So we still have, even with the California Earthquake Authority, if we're not communicating that risk and having people understand what that risk is, then it's all in vain.
Absolutely. Well, we've got about 10 minutes left before we have a well-earned drink, and I'm sure canapes. Any questions? And this is, how can I put it? All questions are welcome, including skeptical questions. Let's air our thoughts and issues. There's a gentleman towards the back, just in the middle towards the back. Oh, went the other side. I thought it was to you, sir, but it's actually on the other corner. So we line them up. That's great. Name and affiliation, please, if that's okay.
Hi. Oh, me first, sorry. All right, I'll go first. I stood up. Sorry. Hi, thank you very much for the presentation. My name is Myris. I'm at Global Council, but I was previously in the Australian government. And in the Australian government, I worked on aid innovation reform about 7 or 8 years ago, particularly looking at the Pacific and doing innovative aid, including climate finance in the Pacific. I think the idea sounds fantastic. It's very interesting, but what next? I think there is a big gap between having a fantastic idea that's innovative, that's cool, that's going to deliver solutions for the people who need it most, and then getting the slow-moving, bureaucratic, difficult systems to actually adopt it. Even if the mechanism is simple, I mean, it's you know, even if it's single premium payment, this is not a complex kind of payout, even that will be challenging to get through international systems. So how are you going to approach that?
Well, I think I'll kick that one to you first, David, and then...
Okay, well, look, I mean...
Do you want to get the microphone?
Sorry, yeah. Thanks, Aaron. I mean, I think that, from my point of view, there's 3 things we need to do. But needing to do them doesn't necessarily answer your question accurately, and I know that. But the 3 things we need to do is, we need to engage with the vulnerable countries and the vulnerable islands. We need to understand the benefit, where they understand it, they want it. You know, my client point, we need the clients to say, this is something we believe is valuable, and a small part of the loss and damage fund should be for this, because Ricardo, you're right, lots of others should be mitigation or what's happened in the past. So this is only a tiny, 1% of the loss and damage fund. So that's the first thing. Second thing, I think we need to engage with business. I think we need business to say, if this was implemented, we would invest more in those countries. We'd build more hotels, we'd build more plant stations, manufacturing plants, we'll do more investment. If business said that, which I know is true, then I think that would be another push. And then thirdly, and this really isn't my job because I don't know how to do this, you need to engage with the donor governments and say, actually, why would you not do this? The clients want it, business wants you to do it, it's clearly efficient, you'd be mad not to. But, you know.
And there has been some discussions with donors, even since the report was published last week.
Yes, so this process, the process of creating this, of carrying out this analysis has been very consultative, and we have had all different groups involved, including Global South, Global North, governments, recipient countries, donors. But of course, it's just doing the analysis in itself, and without really, the first time that something like this has been done, has been carried out to this scale, we didn't quite know what we were going to be able to propose and what exactly we were going to find. So now that we have, just on time for COP, now that we have the results and we have quantification and we have maths to add to the discussions, then that's when we'll certainly just amplify our outreach, and we are just very keen in just taking this to every government, donor and recipient. So all of you here in the room, if you have any ideas, any avenues, please do engage with us. It's just this has been carried out to now action it, not to sit on a shelf. And it will take all of us in this room and many more. So please do come along, and I fully support the action points that David has highlighted.
Great. I think, anyone else? Jorge, did you want to say anything? Or?
One thought that we've been discussing also with donors, along with Anna and Rowan, is that this doesn't need to be a new facility or something that we start from scratch. Right. There are mechanisms around the world that, easily could host some of these elements. From the Global Shield as a global mechanism to, the regional risk pools, to other kind of public-private mechanisms that could be either global or regional. So it's a matter of how it fits with the viability of these mechanisms to make it work. And so that's Marius is an excellent question. I think it's a question to be answered yet.
I remember this initiative was slightly prompted in the aftermath of the last COP with this phrase, loss and damage will be delivered through a mosaic of solutions. A mosaic of solutions to create a picture. And so we thought this could represent a few important tiles on that mosaic, hopefully some bright tiles. I think there's a question right in the far corner, sir.
Stuart Brocklehurst, Deputy Vice-Chancellor, Exeter University. So we often speak of public sector funds as providing catalytic finance because they trigger the flow of private sector funds if they're used correctly. I wonder, given concerns over whether commitments to the Loss and Damage Fund will translate into countries handing over cold, hard cash, is there a possibility here that private sector finance could catalyse the flow of public sector funds? Could that be something this insurance model might trigger?
Anna, do you want to pick that one up? This loss and damage, the loss and damage funds could catalyse private sector,
No, so I'm saying we tend to think of public sector money as catalytic.
Yeah.
I'm wondering if we should reverse our thinking here. There's a concern of whether public sector money is really going to flow. You pledge $100 million, will you actually ever hand it over? Could there be a role here that the private sector could take the lead in establishing the mechanisms which could then drag that public sector monies forward? So the private sector becomes the catalyst, not the public sector.
Yes, okay. So, David, I'm sure that he'll also want to join in this question. What I would like to actually just emphasize here, that we have just very much looked into this in the study, is what already the private sector brings to the table. And the thing with this, with insurance and the fact of risk capital markets products, the fact that just the premium initially, so we're saying in the context of loss and damage, comes from the public sector, is indeed exactly only to only to open the doors to the private sector. The private sector already puts so much on the table, and because it's not unlike an investment that is seen straight away, so because the private sector puts it in a contingent way, doesn't look so big to start with, and it looks as if it's more the public sector that is creating the effort of coming to the table. But the private sector is coming to the table in a big way, taking massive risks with providing contingent capital. And one of the examples that we highlight in the report is the recent, even if it's not climate related, it's a very good example, the Moroccan earthquake that tragically happened recently. So it received $275 million from the risk capital markets. The government of Morocco had only put that program in place 3 years ago, so it only paid 3 premiums, a tiny amount. The private sector, the risk capital markets, they put all the rest. So it's just to emphasize that, and I think it's just as we try to leverage during the loss and damage negotiations, and as we bring the public sector to understand in a bigger way in the context of the negotiations how much the risk capital markets can contribute to the funds that are being raised and that are being offered. I think it's just this reverse dynamic of coverage and of what the private sector puts on the table is very important to keep it in mind. But I think it's just yes.
I was going to say, I think the incentive is, and some of us have been in this space a while, you constantly hear people saying, yeah, the governments are putting in the premium, what's the private sector putting in? And it's not until you show those bar graphs, and the incentive is the size of those bar graphs. It's as soon as that small sliver of orange is paid, the risk then becomes a contractual obligation of the risk capital markets ultimately to that scale. Won't be those size payouts always. That's the maximum loss we were looking at is 1 in 1,000. So this covers all risks up to 1 in 1,000 return periods. And people say, no, 1 in 1,000 never happens. Well, it wasn't quite 1 in 1,000, but it was getting close, wasn't it? So, and it certainly happened 1 in 3,000 in New Zealand a decade ago. So that is, and just because, as you said, it's just because it isn't a school that's built immediately, it's a contingent obligation. It's massive. David, anything else you wanted to add?
I think you've answered the question on the business side of it, because I think the equation is very clear. I do think there's an interesting point that you move slightly away from business and you move into the foundations that businesses have created, philanthropy. I think there is a lot of activity already happening there where foundations are recognizing that this type of mechanism is an incredibly efficient way for them to use their funds effectively around climate risk. So it's not quite private, but it is private, but it's the money that businessmen have made and women have made then being used in a way to fund that premium.
Now,
I think it's
Ricardo.
also just a reminder that, this, even if we were to get to, 100%, right, where we can unlock this much money, it's still, in some cases, not going to be enough. And so it's important to also understand that the insurance component is only one part of a much more comprehensive strategy. So we're not here, proselytizing this is going to be the end-all be-all, but this is an important component to an overall strategy.
Yeah. And it's really only the loss and damage funding that's really allocated towards this sort of thing.
Exactly.
I mean, that's what's the difference. Now, I know we are into drinks time. I'm going to beg your patience because we're just getting going. But we know how to put on a party here at Howden, so we won't be long. But I'm going to have 3 quick questions. I think there's one gentleman, Sid, at the back. I think there's 2 questions here. I'm going to take all 3. Any more? We're not very gender balanced with questions. A lady over here, that's fantastic. Are you a man or a woman? I can't see from here. A lady, definitely, get your question. So 5 questions, and then we'll... we can't see anything. I'm so sorry. So excuse me. I am blind, but it was right. I have just blown everything, and I'll never be invited to be a moderator again. I almost blew it at an IDF meeting about 4 months ago. So 1, 2, 3, 4, 5. Off we go.
Thanks, Rowan. Mine's less of a question and more of an accolade, to be quite honest, which cuts across a number of points that have been made. I came off a call earlier today to one of the big international banks who want to talk both with ClimateWise and with Howdens about how they can get involved in implementing this.
Well, that's fantastic. Thank you, Sid, for that news. Bravo. If they're in Dubai, invite them for a drink. That's what I say.
Hello, my name is Beatrice. I work for Micro. We work in microinsurance for natural disasters and smallholder with smallholder farmers. And my question is, how do you align incentives in all the reinsurance chain to make this possible? If I show this slide to the people with whom I negotiate on a daily basis premium prices for my projects, they would say absolutely no. So this discussion, it's brilliant because the idea is obvious to put together loss and damage funds with insurance, but at very high level.
Yes.
How we can go down and ensure that people who have bonuses and all their objectives, annual objectives on managing programs with loss ratio really not that high.
Yeah. Understood. No, this was definitely looking at a macro structural protection. There's a whole additional level of how you manage things that, how you spend that money and how you manage things but beneath that level, but absolutely.
So how do you see that from the reinsurance sector?
Absolutely. We'll just take the other questions, and I think the answers might have to come in the bar, I'm afraid. David.
Yeah, thank you. David Hart with the Climate Champions. I work with Dr. Mihundin from Egypt and Her Excellency Razan Al-Mubarak. So I came in late, but so this might have been said already, but they're really interested in this idea and how it can be taken forward. But also, much more needs to happen. And again, really interested to speak to others, but also businesses in your supply chains, what can you do to invest in this? It's not just the insurance side, but fantastic leadership, but looking forward to doing much, much more, because the need and urgency is not fantastic, it's just immense.
You're such a tough taskmaster, David. There we go. Always, no, thanks. That's a great point. And I think, David, you were saying that about the role of business to both support this, but also, manage the risk, as you were saying.
Yes, good afternoon. My name is Henri Domel. I'm working for United Nations Capital Development Fund. Thanks for an amazing panel. So, I was very struck by some of the figures you mentioned, especially some of the Pacific Island, because as Joran, we have launched a program on basically providing and expanding parametric risk insurance for the local population provided through their mobile wallets. And we have seen a very interesting result for that. So my question was, how do you articulate these kind of proposal at the macro level and trying to cover the risk of those countries with parametric risk insurance reaching individual sometime in anticipation of cyclone, as we are testing right now? Because on those products at individual level, the price is high, the premium are high. Would it be a way to even try to lower that premium, leveraging some of the muscles that you have in negotiating this kind of national coverage? But and you talk about mosaic, Rowan.
And I think that's the blend we're talking about. I mean, what was exciting about the example that Anna talked about, Morocco, the sovereign level scheme, that actually some of those proceeds were, I know that they were planned to, I'm not absolutely sure how it happened, but I think it did, would go into the social security accounts of people in Morocco in the remote mountain regions that were protected. So I think if we can marry the efficiency of doing this at scale, but then get it delivered locally, that would be the magic. And there's no reason why that can't happen. Final question.
I'll just say that for me,
Ricardo.
To answer your question, they go hand in hand. I think that one cannot go without the other, in my opinion.
And finally, bring us home.
Thank you. My name is Inge Rolf. We have a foundation called Global Choices that really looks at climate risk. Now, this may have been addressed because I came a little late, but Commissioner Lara, you said the big thing is mitigation. How about prevention? How activist would the insurance industry be, and what incentives do we need to make the insurance industry activists and say, no, we will not insure? Because we now know there are certain things that absolutely are causality and the main causes of some of the things that you're mitigating down the line. How do you feel about not insuring or making it so punitive that you don't invest in things like shipping through the Arctic or some of the oil and gas industries or the deep sea mining? That has a very powerful, we've seen it, a very powerful effect. And can there be some mechanism to incentivize doing that?
Sure.
So it's the other end.
It's a huge question. I know that Commissioner Lara could probably talk to you for an hour or so about the effect of insurers coming on. I would also say that the priority of this particular project is to focus on those countries which absolutely will need some protection, and how can that be provided. I know we're over time. I'm going to make an executive decision. The final word should go to Ambassador Barron to say what your closing remarks, and then all answers can then be provided over a drink. But Ambassador Barron, please bring us home.
Thank you very much. And this really has been an interesting discussion. And just to perhaps come after the last speaker in terms of how the insurance would view persons who are perhaps either taking mitigating action or not taking mitigating action. What we want to see happen is that our efforts at building resilience can translate to lower premiums for insurance generally, so that you can increase the insurance coverage. But I think this discussion has been very important for us. It's something, and I take the Commissioner's comments that this is just one aspect of the wider package that needs to be put together when we talk about the issue of loss and damage and being able to respond to the needs of small states. So this is the start of a very good conversation, and we hope to see that continue.
Thank you so much. We look forward to continuing that conversation in Dominica. Absolutely. There we go. Is that all right, David? Can I go to Dominica and talk about? Okay, fantastic. All right. Well, listen. Thank you so much. If I can ask the panelists to hang on for a moment, just to have a photograph taken. But otherwise, thank you to our panelists and to you all.
Just to say one thing really quickly, thank you everybody for attending today's session. We'll have more exciting sessions tomorrow again. The theme would be clean energy transition and renewable energy. So, invite your colleagues and, decompress, have a drink this afternoon. See you tomorrow.